Welcome to Data Bull YouTube channel. Have you ever wondered why 99% of traders fail in the market? Even after learning charts, indicators, and price action, they enter with confidence, only to exit with regret. It's not just bad strategy, it's emotions, mindset, and lack of discipline. In this video, we'll break down the hidden reasons most traders lose, and how you can avoid becoming part of the 99%. Point number 1. Lack of confidence despite research. Even after hours of research, studying charts, company reports, and market trends, many traders still fail due to emotional weakness. They exit too early when things don't go their way, despite having a solid plan. For example, a trader enters Apple stock at $180, targeting $200 after strong analysis. The next day, it dips to $176. Fear takes over. They either sell at $176, accepting a loss, or wait for it to bounce back and exit at $180 with a tiny profit. But just days later, the stock rallies to $200, exactly as predicted. They had the right setup, but lacked the confidence and patience to let the trade work. That's not a technical failure, it's a psychological one. Point number 2. Trying to catch a falling knife. Many traders jump into a crashing stock thinking it's a great, by the dip opportunity, without waiting for signs of stability. This impulsive behavior often leads to catching the wrong end of the move. Example: a stock is falling from $100 to $80 in a sharp downtrend. The trader thinks it's already down 20%, it must bounce soon. They buy at $80, but the stock keeps dropping to $75, $70, even $65. Instead of waiting for the dust to settle, like a trend reversal or volume confirmation, they act too soon and end up riding the loss. Trying to catch a falling knife may look brave, but in trading, it's often just reckless. Point number 3. Revenge trading. Revenge trading happens when a trader takes impulsive trades after a loss, trying to win it back quickly. Instead of following logic, they let emotions, especially anger and frustration, take over, often compounding the loss. Example: a trader takes a loss of $200 on a trade. Frustrated, they jump into another trade immediately, without proper analysis, just to recover the money. That trade also fails, and they lose another $300. Now desperate, they double the position size, chasing a win, and lose $500 more. What started as a small loss turned into a huge one, all because they couldn't walk away and reset. Key message: one loss doesn't kill your account, revenge trading does. Problem recap. Point number 1. Traders panic and exit too early, even when their research is solid, because they lack emotional discipline. Solution: create and trust a trading plan. Predefine entry, target, and stop-loss levels before taking the trade. Use risk management rules. Risk only 1 to 2% per trade, so losses feel manageable. Accept temporary drawdowns as part of the game. Keep a trading journal to reflect on past trades. This builds confidence over time. Practice mindfulness or meditation to reduce emotional reactions. Example: in the Apple trade from $180 to $200, the plan must be: I will hold until $200 unless it closes below $175, stop loss. Stick to that rule, don't exit emotionally at $176 or $180. Key takeaway: have a written plan and follow it like a robot. Let the market prove you wrong, not your fear. Problem recap. Point number 2. Trying to catch a falling knife. Traders impulsively buy the dip during a downtrend without confirmation, and the losses pile up. Solution: wait for confirmation before entry. Look for trend reversal signals like a double bottom, bullish engulfing, or higher high plus higher low. Use volume spikes or support zones to confirm accumulation. Use a smaller position if attempting early entry, at only when the reversal is validated. Alternatively, use alerts to get in after a reversal, not during the fall. Example fix: if a stock falls from $100 to $80, wait for a candle to close above $85 with increasing volume. Don't act just because it feels cheap. Key takeaway: don't be a hero. Wait for signs of strength before risking your capital. Problem recap. Point number 3. Revenge trading. After a loss, traders rush into new trades out of frustration, trying to win back money, which leads to even bigger losses. Solution: pause and reset emotionally. Set a cool-off rule. No new trades for 1 to 2 hours, or until next day, after a loss. Take a walk or break. Do not stay glued to the screen when emotions run high. Limit yourself to a maximum number of trades per day, 2 to 3. Use a loss limit per day, 3% of portfolio. Stop when hit. Focus on long-term consistency over short-term recovery. Example fix. After a $200 loss, walk away. Review the setup calmly after some time. Don't take a revenge trade. Wait for a clean, high-probability entry the next day. Key takeaway: one bad trade is a scratch. Revenge trades can destroy your entire month. Play defense, not just offense. Most traders don't fail because they lack knowledge. They fail because they lack control. If you master your mindset, follow your system, and protect your capital, you won't just survive, you'll thrive. Start thinking like the 1%, and soon you'll trade like them. Thanks for watching Datable. If you found this video helpful, don't forget to subscribe for more insights and tips to help you grow and succeed.